If you're coming into risk management, you need to know how to use an Excel spreadsheet. Like I have people on my team that came from the business and joined risk management, young professionals. And the first thing I do is put them through, Power BI, Excel, Tableau 101.
This is Net Learnings, the podcast that keeps finance and banking professionals ahead of the curve. In each episode, we focus on career growth and practical advice, while mixing in the occasional war story. Join us as we tap into the minds of leaders and experts at some of the world's most notable financial services firms and enterprises. Let's get started.
Hello and welcome to Net Learnings. I'm your host, Kyle Peterty. Today's guest is Aaron Corr, VP and Chief Risk Officer at MCAN Financial Group, which is one of Canada's largest independent mortgage finance companies. Aaron brings nearly 15 years of experience in a variety of really interesting roles, ranging from business analyst to options trader to now enterprise risk management. Aaron, welcome to the podcast. Thank you so much for joining me.
Thanks for having me, Kyle. It's good to be here.
And we're going to talk risk management, obviously, a lot. And there are a few different directions that we can go. But I think an important sort of jumping off point would be just having you define what is risk management in your own words.
Sure. So I'm sure there's a formal definition for this, and various different CROs of different organizations would give you a different response based on, the risks apparent to their own business model. But the notes I jotted down, what I think real risk management is to provide thoughtful and purposeful challenge and oversight from a risk perspective of an investment, a transaction, a process, a new product, a market, whatever is really in question, which will essentially enable a higher success rate of execution, essentially supporting strategy at the end of the day. And to give you an example of this, we are internal risk managers every day. So let's say you're a private investor, Kyle. You have a few $1,000 to invest in something. You want to put your money in something other than a savings account. And, you choose your first vehicle as something pretty safe, maybe like a market toggled ETF for your first investment. So getting to this actual decision required several levels of internal risk tolerance checks. You've rationalized your decision to take on more risk to invest in something other than a savings account. And your first big investment is, pretty safe, a market toggled ETF. Mm-hmm. So this is really internal risk management. Now, we also call this risk appetite as well. And it's understanding, how much risk you're willing to take and what you're not to take. And this is usually toggled to a yield as well, how much money you're going to make from a risk-based decision, right? So now let's say you've made a little bit of money. And now you want to start taking on more risk. You want to buy maybe individual stocks or even looking at the feasibility of option trading. So getting to this decision actually hopefully required a lot more risk decision thinking. Perhaps you did more research. Maybe you checked with professionals. Maybe you read a book or two. Maybe you even bounced ideas off your network. And what this means is you've moved up the risk curve, essentially. Your tolerance is changing. Your risk appetite is changing. You're willing to take on more risk. But why are you willing to take on more risk, Kyle? Because you want to make more money, right? And so this, again, is a clear example of risk management and risk tolerance and risk appetite. And, this ideology can be applied to risk management professionals as well. So every day we make investment decisions in finance, right? We have to think about if we want to invest in large projects, if we want to put money or capital behind individual borrowers, whatever, right? So as a part of a risk manager's decision is to first ask questions, so banker, capital markets guy, or even let's say, retail lending. Part of risk management job is to just ask questions, is about the deal, to flush out the risks of the deal. And then we also do a second check to say, does this deal or this investment or transaction or product, does this fit our brand? Is this within our risk tolerance? Is this within our risk appetite? We wouldn't want to be investing in something that we don't know anything about. If we don't know anything about that, we'd probably get well researched before making that investment transaction. So this is a pretty layman example of, a typical risk manager's job. But there's much more to it, right? So we don't only provide oversight and challenge of our deals, we also provide a bit of oversight over operations as well. So let's say, Kyle, we said, okay, we gave you the green light, go put your money in that, 6-story condo, whatever. Kyle, I think also you should track data, and we'll give you certain advice on which data you should track. And we use this data to essentially form other decisions in the future. We test our performance, we test the risk parameters, we test to see if this was a good transaction, if we want to keep doing it in the future. So risk management also provides a lot of, support to enhancing the processes to make better investment decisions in the future. So at the end of the day, we support strategy. Historically, and when I mean historically, I mean up until the last 10 years, risk managers were really reviewed as cops, right? Like you can do this business or you can't do this business. And, people kind of shunned away from risk management for that purpose because, no one wanted to deal with them. And what's really happened in the last 10, 15 years is that risk management has transitioned. It's not all black and white anymore. It's very much gray. And what the best risk managements are is to help support and enable business and really flesh out the risks in whatever you're talking about.
Yeah, no, that was a really good, really comprehensive explanation. And it's true, the reputation of the risk folks being the wet blankets in the organization, long-lived, but is changing. It seems to be changing a lot. And part of the conversation today is going to be around why you might want to consider a career in risk management. And we're going to get to that. So you talked a lot about making capital allocation decisions in real estate decisions there. And that's, I believe, what MCAN does. So I want to talk about MCAN, your company, and maybe more broadly, like, mortgage investment companies. Because if I were to say, BMO or Wells Fargo or something like that, most folks listening would instinctively know exactly what those firms do, right? There's some moving parts, but they're banks at the end of the day. And that I've found is not always quite so cut and dry with mortgage companies or with asset management firms in the real estate space. Like those, I think, also sometimes get conflated. And the business is just a little bit opaque, right? Like some are eligible for deposit insurance, some not, some hold exposure on their balance sheet, some securitize it, and so on. So that's a lot, but I'm hoping you can maybe just tell us a bit about MCAN and what the company does and how it does it.
Sure. So MCAN's an investor in 3 main product lines, essentially, and it's all a little bit more higher risk than the traditional banks. So we're up the risk curve. We have more risk tolerance, as I mentioned before. So the 3 main product lines is really construction, commercial investing. So we're putting our capital behind larger projects, usually focused on residential lending, but you could put money behind commercial, industrial, whatever. But our main focus is residential lending. We also invest in higher risk mortgages too. So this is mortgages to people like you and I that are just looking to, get a mortgage and a home to live in. And we also invest in marketable and non-marketable securities. And essentially a non-marketable security is just a pool of fund to invest in large projects. So the main difference, though, between a large bank like Wells Fargo or BMO is that, we have higher risk tolerance, and that's because our cost of capital is essentially higher. And so what do I mean by this? So let me break this down into simplest terms. The banks, they pull their funding sources from checking accounts, savings accounts primarily. These are pretty sticky deposits. They're super low yielding. They don't pay any money for this. And they also get funding through other means as well, right? And then they deploy this capital into assets, the assets that we all know, credit cards, mortgages, lines of credit, non-retail, whatever. And they make that yield, right? They make a spread off that. So at MCAN, we do exactly the same thing, right? But we just moved up the risk curve a bit because our cost of capital is actually inherently a little higher. So we don't offer checking accounts and savings accounts. If we did, we'd be a bank. Instead,
Right.
we issue, term deposits, GICs, and we have other funding channels as well. And these have a higher coupon that we have to pay for. And because it has a higher coupon, we have to earn our own NIM or yield on it. So we go up the risk curve and we traditionally loan to higher yielding assets to earn that NIM essentially.
NIM
And
being
that's,
net interest margin. Sorry for
yes,
folks
net
that
interest
don't know the
margin.
term.
Yeah.
Okay.
So in very simple terms, we are higher up the risk curve than the banks. But to be honest, I wouldn't say we are inherently more risky. What do we invest in or who do we invest in? So, non-bankable borrowers, which essentially could be borrowers with, a weird credit history, or even borrowers where their income is not so clear cut. So you and I both work for companies, our paychecks probably come twice a month, right? The banks like that kind of information. But if you're a business, especially a small business, your income might be quite varied, or, you can't track it as strongly as ours. And so, banks kind of avoid that kind of business as well. So we do that kind of business. On the non-retail side, again, non-bankable clients. So banks are more interested in, pretty high net worth developers and builders. In terms of real estate, we're talking about the pretty big developers, Tridel, whatever. For us, we'll do business with borrowers that have built less projects, but have had experience building projects, right? We're not going with people that have never built anything ever, or maybe their net worth is not as high. So there's inherently more risk in these deals. But if you actually look at the history of our performance, we've actually lost less money than the banks. And the reason for this is because we have clear risk management policies, processes. We've identified our own risk appetite and tolerance, and we stick to it. We do the business which we know, which enables us to grow, earn that yield, and, not lose money at the same time. So just because you're up the risk curve doesn't necessarily mean you're actually taking on more risk or potentially losing more money. Similar businesses to MCAN, I would say, is Equitable Bank, which is actually quite grown quite exponentially the last few years. Home Trust, which just got bought out. They're both, which we call traditionally B lenders. So people with, these are higher risk mortgages. In the US, there's so many different comparables, but the market is actually completely different there. The terms and structure of their mortgages is very different than Canada. In Canada, our terms are traditionally 5 years where you renew the mortgage. In the US, they go out to 30 years or so. And so it's a much different environment as well. And just because in our banking system, we kind of have an oligopoly going on with the 6 DSIBs.
Yeah.
In the US, it's much different, right? They have tens of thousands of different banks and different structures and different regulations as well. So it's tough to pick out in a direct competitor.
Yeah. No, that's fair. I was going to ask about other companies that people could sort of compare or understand against. So that is really helpful. Okay, we're going to get to why people should consider a career in risk management eventually. But before we do, you've talked a lot about sort of some credit risk and financial risk. I think it would be useful to understand the space more broadly, though. And I want to ask a multi-part question. The first is, what are the specific types of risks that risk managers manage? Because if you work at a corporate, it would be different than if you work in financial services. And 2, what are the types of roles that specifically exist out there in risk management?
Sure. So risk management, I would say, without a doubt, has more technical roles than non-technical roles. Okay. Generally speaking, the folks that work in risk management have some sort of financial education. And I would say anyone who's a manager or above, high probability that they have, 3 letters behind their name, whether it's like a CFA, an MBA, or CPA. And it's because the roles that they're conducting are traditionally more technical in nature. That said, there's a lot of non-technical roles that are becoming more and more apparent in the industry, and it's just a factor of technology, which I'll talk about in a minute. But to give you an example of the types of roles, I'll broadly categorize them in terms of risk type. So credit risk, and we can separate this out into, 2 real functions. We have retail credit risk, which is, loaning to us, right? Credit cards, mortgages, lines of credit. People, yeah. And, risk management, these are commodities too, right? There's less of a human element to it. It's more based on risk parameters, and they've been stressed from a technical perspective to understand, probabilities of default with a lot of certainty, right? Like we have credit scores, and that goes into these decisions. And so a lot of a risk manager's job in this type of field, is policies, oversight, monitoring, reviewing changes, challenging going into certain markets and so on and so forth. The other side of credit risk is non-retail. So this is kind of like a bit bigger than small business, commercial lending, and corporate lending. So these deals can vary in degree of complexity, right? I would say, commercial loans, pretty complex. You might have, 10 million to a few hundred million. We're talking about people building manufacturing lines in Ontario or different provinces, and they're, showing their financial statements to a banker and they're recommending a decision. And risk management provides their oversight and challenge of this decision. And this goes up to corporate banking as well. So, lending to, let's say, Samsung or, Brookfield, much larger businesses. And the same rigor and process goes through this too. So they're the real risk managers. They're on analyzing the risks, but they're also sending this to risk management. We provide oversight and challenge of these roles as well. Now, this is the most traditional form of risk management. And when people think of risk management, I think they think of these types of roles. But there's also, liquidity, market, and interest rate risk. And this is really treasury and liquidity risk management. And these are super technical roles. So every organization should have a treasury or some sort of liquidity function. So there's a risk management element to that too. So we're looking at funding risk to making sure that, businesses have adequate lever to fund their business. Market risk is to ensure that the exposures you have on your balance sheet, understanding the potential risk of loss there. So, Kyle, interest rates are inversely related with valuations. So interest rates go up, valuations go down. We should understand as risk management professionals the potential loss of this change and the potential impact on the assets in our balance sheet. And those are really, higher technical, working with finance, working with the treasurer and those types of roles. Generally speaking, CFA type of education for those types of roles, just because you're using more complicated instruments like derivatives and other hedging instruments to, protect your P&L, essentially, profit and loss in your statements. A more common type of role is really reporting, monitoring, data analysis. So every organization has some sort of level of enterprise risk management. Traditionally, this role is, conceptualizing the risks in your business, your role profile, and escalating or communicating this to senior management in the business. This is done through a function of key performance indicators or key risk indicators. But risk management also plays a big role in data management as well. Crunching a lot of data. There's a lot of stress testing involved here as well, scenario analysis. Another big body of work that's actually happened in the last 5 to 10 years with risk management professionals is model development, actually, or model validation. And, this model development can sit in the business, it can sit in finance, it can sit in risk management. A lot of the time it sits in risk management. These roles, a lot of education, right? You need to have high financial literacy. You need to understand the business. You need to usually know statistics, coding, and also be able to communicate what you're producing as well, and allowing the business to understand the models so that we can provide, oversight and challenge to ensure they're working as well. Those are the most common technical type of roles. The less technical kind of role is operational risk. And this is usually falling under the enterprise risk pillar as well. Traditionally, and operational risk was more so looking at your processes. So, every organization has hundreds and thousands of processes. The larger the institution, the more complicated the process. So we, at my organization, we're not so big. So we've identified, critical processes, less critical processes. And we want to understand the risks to these processes. We want to understand the controls within these processes. And we want to understand that, if there's disruption to this process, what do we do to ensure that this process is back online so we can continue business? So you think of, business continuity plans, scenario testing, and so on and so forth. And this field of risk management is actually getting quite a lot of attention recently, and a lot more investments gone into this part of risk management. And it's because technology and the emergence of technology has become a big game changer in all institutions and industries, right? So instead of, my company developing technology, we go to third parties for that now. And so are the bigger banks too. So more and more companies are getting third parties and bringing that to, provide a service or solve a problem for us. And once you start going to third parties, you're actually opening yourself up to more cybersecurity risk as well. So
I wanted to ask about that. Where does cybersecurity risk fit in? It's such a buzzword.
So operational risk is a catch-all for cybersecurity, third party, could be fraud, could be built into that too. Anti-money laundering.
Risk? Is climate in there?
Climate risk goes in there. And so because our processes with the emergence of technologies becoming more complicated, these risk types as well have become more and more important, especially for the regulator as well. They're expecting risk management companies to put more investment in understanding the risks with these as well.
Okay, that's really helpful context. Thank you. A lot of folks listening will be in financial services, probably in some capacity. I'd love for you to unpack some of the lessons that were learned maybe from like the SVB, Silicon Valley Bank collapse, or Credit Suisse or something. Like it'd be cool to kind of draw a parallel to something that's happened recently in the market. Are you able to tie these back to some of those specific technical areas that you just talked about?
Sure. So this is great because SVB was like a case for all businesses to learn from, essentially from a risk management perspective. So SVB was, one of the largest financial institution failures since date. Their business model was mostly lending to venture capital and tech firms, essentially. And this actually inherently has a lot of risk to it as well, because, who are their depositors? They're not sticky. So they're non-retail deposits. So their liability side of their balance sheet essentially has lump sums of money from companies. Whereas let's say you look at a big bank, where do their deposits come from? Well, they come from Kyle and Aaron, right? Our money in their checking accounts. They also come from commercial partnerships as well. So anyways, let me get into what happened with SVB. But essentially, they were invested in quite a lot of 10-year treasuries, right? 10-year treasuries as their assets. And while interest rates started going up, valuations go down. So they started taking big losses on these treasury holdings. And when they finally pulled the trigger and sold, they lost something like $1.8 billion in losses. Okay. So they held all this information internally. But as soon as this information became public, the worst thing possible happened to their institution. A run on the bank happened. And what does a run on the bank mean? A run on the bank means is when customers who are dealing with this, people like us who have retail deposits in their business, they freak out and they want to pull these deposits out of their business. So like what I was saying before is that so these venture and fintechs started pulling money out of their accounts quickly. And it's easy to drain the coffers quickly if there's fewer deposits in there and they're lumpy.
Whereas hundreds of millions at a time.
Hundreds of millions at a time. Whereas let's say if there's a run on the bank on Wells Fargo, you need literally tens of millions of borrowers to pull money out of that account, right?
Or depositors, you mean?
Or depositors, sorry.
Yeah.
So that was the biggest issue there was that, first they lost a whole whack of money and then there was a run on the bank. So the solution to this problem is to get capitalized at the end of the day. And what does that mean? It's to go to the market, sell your equity, sell shares of your company and start bringing more money to, keep the lights on. But, I think the news cycle just got too vicious and they couldn't recover from that. And so, what was these case studies and learning opportunities from this? So we dive deep into what happened and we can break it down into a few things. There was really poor risk governance there. So What do I mean by that? They didn't have a CRO for 8 months and their board of directors had only one board with risk management experience. Okay. So without a CRO or proper risk oversight from a board perspective, there's no firepower to escalate, communicate any issues across the organization to get ahead of them and start curbing any of the risk. So that was huge fundamental issues from a governance perspective. But if we look at from a more technical perspective, they failed Risk Management 101 on liquidity, interest rate, and market risk. And so, as I was mentioning before, types of careers in risk management, you have liquidity, market, interest rate. So what do they do from a funding risk perspective? They were funding their business through non-sticky deposits, which is not good. You should diversify your deposits, right? So they failed on funding risk. From a liquidity, actually, I'll skip that one. You're supposed to also match your assets and liabilities as well. This is a key.
Yeah, we hear about that. Asset liability matching, right?
Yes. You wanted to match the duration of your assets. Essentially, your cash flows come up for renewal at the same time. So there's no big cash flow concerns at any given time in the future. We think about what happened. They had 1-day deposits on their liability side and 10-year treasuries on their asset side. That is a huge bifurcation of duration, right? Yeah. So that is like failure of risk management 101 on that point as well. Also, market risk. right? They should know the total exposure of those 10-year treasuries. And, as a financial professional, everything we do is toggled to interest rates, right? So they should have had some sort of strategy or monitoring system or something to tell them when interest rates start going up, the valuation of your treasuries is going to go down. And at which means are you going to start selling these? You don't need to sell them all at once, but you should start layering sales, or you should start putting hedges on this as well to mitigate that risk. But so the case study of SVB is that they actually said in their policies and procedures and their just financial disclosures that they do all these things. But when in reality, we saw what happened to them, it seems like they didn't do them, or maybe they didn't do them in depth enough to actually give them signals to take action and mitigate these risks.
Yeah, it's such an interesting story and so counterintuitive because, the government 10-year bonds are effectively what interest rates and prices are based off of, right? The counterparty risk is virtually zero. And I'm sure on the surface, everyone just assumes, well, there's no counterparty risk on treasuries. But because of that inverse relationship to asset prices and interest rates, they just got punished. It's really quite an interesting story.
1.8 billion is an astonishing amount of money to lose on a single type of asset.
Yeah, it's wild. Great perspective and an interesting case study on why risk management is so important. Let's get into the sales pitch part. Help our listeners and our members understand the top 5 reasons why someone should consider a career in risk management. You've made it sound certainly very interesting. Let's hear what your reasons are. What's number 1?
Okay, so first of all, I didn't think I would ever become a risk management professional, but I really enjoy this career. And I'll give you the top, 5 reasons. First of all, generally speaking, they're higher paying jobs. So because I mentioned earlier, a lot of these roles are pretty technical. They require a lot of financial literacy and education. They're one of the higher paying positions within the organization. Like obviously you have bankers and capital market guys that are paid on commission based. But aside from those types of roles, if you look at the organization as a whole, risk management professionals are often paid pretty darn high.
That's interesting. I don't think I knew that.
Yeah. Number 2, job stability, right? So,
okay, explain.
So pardon my French, when shit hits the fan, often you need risk management professionals. And so we're in an interesting credit cycle right now. And all banks are kind of pulling back in terms of their staffing and their human capital. I can guarantee you a lot of the recent announcements, not a lot of them are risk management focused, because a lot in this environment, risk management is actually utilized even more to understand the risks, communicate the risks, and escalate the risks to either senior management and the board. And so there's more, I would say, job security in a risk management profession as well.
On balance, interesting, because you would think of them on the surface as a cost center. And usually it's cost centers, not revenue centers that get wiped out when times are tough. But you're saying they're a little bit insulated from that.
Yes, that's true. Okay, number 3.
Okay, number 3. Yeah, what's number 3?
Transferable skills. And so what do I mean by this is that the same principles you learn and apply in risk management you can often apply to all other financial institutions. So, banks, trust companies, insurance companies, fintechs, whatever, but also they're transferable to other industries as well.
Like large corporates, right?
Large corporates. I've been, throughout my career, not just in this role, I've been contacted for energy, utilities, telecom, nuclear power facilities, grocery, consumer goods, all sorts of disciplines. And so it's the same principles that you can apply to all industries. So your career opportunities is quite larger than most people think. Yeah.
Okay, transfer. So we got high paying, stability, transferable skills. What's number 4?
Number 4, impact on decision making. So what does this mean is that a lot of the times in risk management, you have a critical role within the organization. You're talking about big deals. You're discussing big deals. And approving these big deals has a big impact on the organization. That's from the credit risk perspective. But also, the business, if they want to engage in new products, new markets, whatever, new processes, usually risk management's involved and our opinions are heard and it impacts the business decision. Essentially, we're supporting strategy at the end of the day, and we're making sure these strategies are executed successfully. So we actually have a higher seat at the table. A lot of the folks you'll talk to in risk management are usually, higher levels in the organization. So you actually have a lot of light shine on you as you progress through your career.
That's very interesting. How often do you reference Ansof's matrix in risk management?
Oh, we use those kind of grids all the time. Tools like this are really utilized to understand our risks and our opportunities as well. So both the business and risk managers use them.
That's great.
Number 5, exposure to various business functions. So similar to number 4 is in risk management, you're working with the business essentially. And traditionally it was working with the business for retail and non-retail credit. But as I mentioned, our jobs have expanded quite a bit. Cybersecurity, climate change, operational risk, third-party risk, new products, processes, finance, compliance. Essentially, in a risk management department, all our hands are in every cookie jar. And so you have a lot of exposure to a lot of different lines of business. And so if you enjoy the work with that line of business, there's often opportunities to actually switch roles and join the business as well. And so a lot of career opportunity in that sense.
Okay, that's quite a list.
Yeah. Now that was the top 5, but I'll give you one other one.
A bonus item.
One, an encore one. And that is work-life balance is pretty good. Yeah. Okay, it all depends on the individual and the type of job you have. If, you have to approve deals and it's coming down the wire, you obviously have to, work those hours.
You're on the hook, yeah.
You're on the hook, right? Because you have a job to do. But at the end of the day, most risk management roles are, 9 to 5. So you get that combined with the, job stability, high pay, and 9 to 5, you can go back to your family at a reasonable time and enjoy that ecosystem as well. All in all, I think these are, pretty good reasons to join risk management.
Yeah, that's a heck of a list, and certainly appreciate you bringing that perspective. Okay, maybe can you tell us a bit about your career and how you got into risk management? You mentioned that you didn't envision going in this direction, but you did.
Yeah, so, long story, right? So I thought I was going to go into a medical career originally. I have, a father and a grandfather who doctors and surgeons. So I thought, medicine was for me. I had the opportunity before going into my undergrad, staying with my uncle who was an SVP in Goldman Sachs, and he was a broker there. So he was looking at equities and recommending them to clients. And so I got to meet his clients. I got to, talk to my uncle about, different equities. I still remember PokerStars standing out a long, long time ago. This was before the emergence of online casinos and any of that kind of stuff, right?
Yeah.
And so he's asking me, do your friends talk about this kind of stuff? Is this an important thing amongst your friends? And so, having these discussions with my uncle got me pretty excited, especially meeting his clients and that kind of atmosphere. And so I originally did my undergrad in medicine, but I switched to a more finance discipline. Through a long story, I actually left my undergrad early to join Scotia iTrade. And I was very, very young at Scotia iTrade. So iTrade is essentially investing direct through equities, options, fixed income for clients and customers. I'm not making those decisions, it's them. I just help them execute this. So young in my career, I became accredited to invest in equities, options, and fixed income. I was the last hiring block before the 2007-2008 crisis. And so that was an absolute bloodbath during that time. I had customers and clients calling me, crying about losses they've made in the market, often trying to trade their way out of it, which is bad from a risk management perspective, I would say. And I saw that this was quite a while ago, so this was like 16, 17 years ago, and capital markets was very inefficient back then. So we knew it was going to start getting digitized and automated. And so I actually jumped to IT for a while, where I was working on Scotia Online, Scotia Mobile, and Scotia iTrade's mobile application. And this was, a very long time ago. So this was like emergence of new technology. So the banks and other institutions were just dumping money into this, trying to, race to provide good products for people to use online. So I brought my, brokerage experience and supported these IT projects as well. Did my MBA, and then I flipped over to, when I got on my MBA, I jumped into risk management. I was lucky. I worked under a vice president in enterprise risk, which was essentially, putting out fires in various different disciplines of risk management. So I was exposed to, credit, liquidity, capital, monitoring, reporting, using, statistical analysis, you name it. So I was exposed to, various different risk management disciplines. And eventually I got headhunted to join MCAN as the director of ERM. And when I joined MCAN, the ERM function was in an infancy stage, I would say. So I had the opportunity to build the whole ERM function. And eventually I got promoted to the chief risk officer, and here I am today. My advice to other, risk management professions is that, there's so many different risk management professions out there. You don't need to typically stick to one line. If you have a subject expertise in credit risk, those are often transferable to enterprise risk or operational risk as well, as long as you know the principles behind it.
Right. So if I were to ask you a true or false question, data science skills are a serious asset in risk management. True or false?
Very true. Extremely true. I would say if you're coming into risk management, you need to know how to use an Excel spreadsheet. Like, I have people on my team that came from the business and joined risk management, young professionals. And the first thing I do is put them through, Power BI, Excel, Tableau 101. I try to get them to get quick on their feet with data analytics and, understand that business decisions come from quantitative analysis. So not only, driving these analytics, but how you communicate it as well. These are fundamentals in risk management.
Yeah. If you weren't in risk management, what would you be doing?
Tough question. Probably something not related to finance.
Maybe medicine?
Maybe medicine. I'm also a DIYer at home. I love building my own furniture. I love working with my hands. I go to Home Depot, I look at the workers there, and I think, I would love the opportunity to help people realize their home improvement dreams as well. Or even the factor of renovating homes, seeing that creativity of what a space you can live in and help execute that. I think that would be a great role. Right now, it's probably not good because the credit cycle is a little bad. But the whole ideology of renovation and producing beautiful spaces to live in is awesome.
You mentioned the credit cycle that may play in here, it may not. But what are 2 or 3 things that are sort of most top of mind for you right now in terms of the year ahead? And just to timestamp, we're recording this in January 2024.
Yeah. So, everyone has different opinions, but the central bank essentially 3 times interest rates, right? They 3 times what it was a year ago. And so it's extremely difficult for people like us who want to get a new mortgage. It's extremely difficult to, just maintain this kind of balance sheet for a lot of people. So there's a lot of uncertainty in the market. There's a lot of uncertainty from a macro perspective too. What's happening with unemployment rates, GDP, you name it. And so as a finance professional, we drop our budget every year and we, theorize where interest rates will be. We don't know. And you know what? I don't know if the central bank even knows too. Everyone has their hypothesis of when interest rates will start dropping, but that might change. History often doesn't repeat itself. And so what we have to do as risk managers is understand that risk, right? Start baking in scenario analysis of interest rates dropping, incrementally starting in spring to, summer. Or what if they drop faster? And what's the impact on your business? What's the impact personally, right? Yeah. And so we need to start thinking about this and thinking about how this impacts our future business as well. We're in the business of real estate. Right now, the market's pretty dry, I would say. But as soon as you drop interest rates, what happens to the business? Maybe housing pace starts picking back up. There's a lot of immigration in Canada and not enough supply of homes. That's another critical factor as well. So essentially, as a risk management profession, Like, I'm trying to think of how do we navigate through this credit cycle and what are the things we should be thinking about before interest rates start dropping? Because we don't know, Kyle, if they're coming off like incrementally or way quicker. History
Or
often
at
doesn't
all.
repeat itself or at all, right? Yeah.
Yeah.
Well, there's a scenario of stagflation too. And so,
Hmm.
my organization, we stress test stagflation. What's the impact on our capital? What's the impact on our liquidity? And what are we going to do? Which kind of levers can we pull to mitigate that kind of scenario as well?
You were in ERM long before the coronavirus pandemic, and I feel compelled to ask, like, how, if at all, the nature of work has kind of changed from pre to post pandemic? Like, has it forced you and people in your type of role to think about tail risk type events differently?
I think what we're seeing from coronavirus, I mean, pre-COVID. So, okay, let's go back a bit. So you had the financial crisis, right? And that was a pretty shock. That was a pretty big financial crisis. Like if you look at from a relative perspective, all the crises out there, that was a pretty big financial crisis. It was like 2 to 3 quarters of negative GDP growth, and it took a while to actually get out of that. But what happened after 2007, 2008? Massive boom in economy, like
Yeah.
big. Like after that, it was great. It was like, after rain, there was sunshine, essentially.
Yep. Yep.
And business was groovy, a lot of business to be made. And then what happened after that is 2010 to about 2015, you had lowering of interest rates slowly in Canada to spur growth. So you saw housing prices start to skyrocket as well. And that was because, the central bank was essentially juicing the market. There was also a lot of quantitative easing as well, pumping liquidity in the market to generate business. More money in the economy, the more business is going to be generated. But these were all more or less typical credit cycles, I would argue. We had the bust from '07, '08, we had the boom thereafter, and then kind of like flattening during the 2010s, right? And then we had COVID happen in 2020. And that was such a shock to the system, okay? Major shock to the system. From an operational perspective, we all learned to work from home. So our technology capabilities just improved vastly, right? We
Yeah.
realized we don't need to go to the office to work necessarily. So that was like a, business continuity plan in action in real life, which was a great learning experience as well. But what happened was then, there was a lot of negativity in the first couple quarters of COVID. And then all governments across the world stepped in and just pumped the economy full of liquidity. And then, the skies were bright, right? Everyone was getting, not everyone, but there was so much money in the economy. We had CERB in Canada. People were buying iPads. Technology was flying off the shelf.
Hmm.
Economy was great. But after that, there's always a bust cycle, right? And what my point that I'm getting to right now is that the bust cycle from COVID was very short, and the boom cycle that happened after that was very short. And this doom and gloom right now is we don't know what kind of cycle this is. Is this going to be a short cycle? Is this going to be a long cycle? So the stagflation, which you brought up, is this going to be longer? And so as risk management professionals, we're also thinking what's going to happen after, right? Are the cycles going to be much more shorter? Or are they going to go to more longer credit cycles where we can manage that risk, manage that assets and liability duration on our balance sheets? Or are they going to be tighter? Do we need to be on our feet all the time as risk management professionals because the credit cycles are going to be boom and bust all the time? My philosophy or my theory is that I think the credit cycles are going to be shorter. I think there's a lot more money in the system now, and the economy is much more global than it was before. The supply chains are much wider, and money comes from many different sources now. And so because of this, I think there's a lot more risk to boom and bust cycles within our economy, and we're just going to have to get used to managing those at the end of the day. And I think that was the biggest the biggest outcome of COVID on enterprise risk management, really.
I'd love to ask a little bit about AI. I mean, obviously a super hot topic today, and I'm sure that as a risk management professional, the proliferation of large language models in particular has gotten your guard up a bit. But with risks come, interesting opportunities. So, a two-part question. Are you willing to sort of share some, general thoughts on AI? And then how, if at all, do you see AI changing the nature of work that folks do in risk management? Maybe for the better even.
Sure. So, yeah, AI is definitely a hot topic. Every boardroom should have some sort of AI expert discussing the opportunities, the risks, the challenges. So, right now, AI is still rather basic, even though there's been like this new blockbuster technology that's come out with ChatGPT. But how it's applicable today with the new technology out there now is that, you know, believe it or not, we have a lot of manual processes, right? Tons and tons of manual processes. There's a lot of writing in risk management as well. So what can AI be used today? Well, every company or every department right now should be thinking about use cases of how to apply AI in their own business. And they can be from anything from like non-sexy to sexy, essentially. So from a non-sexy perspective of AI is from a risk perspective, we have to escalate, unusual transactions to the business, to risk management, sometimes to regulators. Sometimes these things can be, a lot of different pages. You can use AI to streamline this to get it down, summarized, and uploaded to the regulator easily, right? What about communications? Employees are communicated to all the time on cultural, on changes in benefits and changes in pay and changes in events. Communications can be streamlined through AI, right? Hey, ChatGPT, help me create a communication on, Habitat for Humanity event coming up with these key aspects of the event to include. It's for day-to-day business as usual process-oriented tasks. It can make life a lot easier. So I would highly recommend, all institutions to kind of take a deeper look at what you do today and how you can apply, just this kind of AI. Then you get into the more sexier type of work too. And so this is more, modeling I'm talking about, right? So right now you have models for investment bank decisions. You have models for all sorts of stuff. So let's say even adjudicating credit, right?
Yep.
So, Kyle, you might be a pretty investment grade guy. You're applying for a mortgage. Could we get AI to auto adjudicate? Maybe an investment decision, you put in your information, investment decision happens within seconds. And before there was machine learning with this kind of stuff, and they more or less kind of figured it out. But now with AI, you can get to much more behavioral characteristics as well to understand if Kyle is actually a good person to loan to. And then it can get more complicated, right? You can get to investment banking, put in a lot more different risk parameters to think about that the model can think about. Now, the challenging part with that is that then you have AI building the model. The models can get much more complicated at the end of the day. So then where does risk management come in? Well, then you'll need risk management professionals to validate that model, to make sure it makes sense just from an intuitive perspective that whatever this AI is generating, it actually makes sense and that we can statistically challenge the decisions.
Yeah. Model validation. There it is. It's back.
Model validation. It's back. Exactly.
Nice. So this has been a really great chat, and you've shed some light on the career prospects and opportunities and sort of some reasons why. I want to be respectful of your time. Where can our listeners go to learn more about you or about MCAN?
So MCAN, we have a presence on obviously all the major platforms, LinkedIn, Instagram, you name it. For myself personally, I don't like to keep a big social media presence, but obviously LinkedIn, you can always hit me up, reach out to me. I've done a lot of mentorship before, just providing advice on, potential career opportunities as well. So yeah, hit me up on LinkedIn, Aaron Corr.
Nice. Okay. Well, again, Aaron, thank you so much for your time. Really, really appreciate it.
Thanks, Kyle. This was fun. I hope this was valuable to your listeners as well. And thank you for this opportunity to share my perspectives on risk management.
Absolutely.
Thanks for listening to this episode of Net Learnings. This podcast is powered by CFI, an organization on a mission to enhance the skills, knowledge, and productivity of finance and banking professionals. If you enjoyed what you heard in this episode, make sure to follow Net Learnings wherever you listen to your favorite podcasts, or visit us online at corporatefinanceinstitute.com/podcast. See you next time.